Okay. Now we can talk markets. All right, so we were looking for the bears to get sampled. Let's take a look at where they're at. It took a while. You know, we stopped about here, or I stopped about here with the live stream thinking we're going to get this to move up. Now we're just getting that lean. You can see we are at -2. That means to get that sample in the next couple minutes, we're going to be looking at -430-ish, maybe a little, maybe 450-ish, somewhere in this range, and that'll give us the bearish sample we have been waiting for. Sponsor, I'd love a sponsor from Red Bull. So you can see we dove down. They gave another look at trying to just move, but like we looked at before, this position, and I'm going to scale this chart a little, squeeze this chart a little bit here. Not squeeze like squeeze the shorts, just squeeze it. These buyers are in positive spreads. That means they own puts. And I'll show you the puts. You know what? I'm not going to theoretical. Oh, and we have that problem again today anyway. So, okay, so look here. Let's see. This is today. This is yesterday. This right here, you see those 1,000 SPX puts. Those are hedging the longs here. You can't run the longs out of the low until their insurance policy expires. So there's a tough low here. These buyers are still just whatever, hanging on. They don't have any risk. All right, there we go. We're at 466. We're getting our sample. These bears are finally getting their second position to try and blast the lows, which they're going to have a really hard time doing because of the positive spread. And anyone who went long in this low, which I don't have any real bullish signals for that, so I'm not putting a plus here. But should there have been anyone, oh, sorry, you can't see that. These 1,000 right here, you could see there's probably a bunch of people who have taken that positive spread. Those puts are ensuring their longs profits. You can't take them out. If you owned a long and you owned a put, and if you did nothing and that put expires, you get profits. You have no risk because if they shove it down or up, doesn't matter. So the bears are in a tough position. I think both of these lows are insured with Geico. Oh, just kidding. With puts. So these bears are going to be trying to work with these bears. So we've got our root position here. You can see we're getting our trapped orders coming in right as we get that sample. Wait for those to finish. I was looking at this level here as being the best spot. I thought for bears to try and pick up another position. I didn't think anything above it looked, you know, because then you start running into problems with your root position, which in this instance, this root is also the origin because it's the highest short position that I can see over the past couple days. So this root would also be an origin. Let me just give you one good rule of thumb. Institutions love their origin position at the higher low. Both sides. Nobody likes an origin position that's 30 points off the high or the low. Nobody. They want it at the extreme. So it's not necessary, but it's a function of pride, and traders with billions of dollars are far more interested in whose is bigger than accuracy. Bigger matters a lot when you have so much money you couldn't spend it. So yes, at the high is important to people who are arrogant pricks. Of course it is. So we want, you know, I'm looking at this as I'm calling it a root because that's an intraday term, and origin is a swing trading term that I just use. I don't know. I just made them up. They're not official. You can't find them on Investopedia. Then if there's, let's say, a bearish position here, and let's just say hypothetically that they were able to run this down in the next couple days, you know, this would be the origin, and I would reference it as the origin of the swing trade. Not here, not here, none of the overnight stuff. Be this position. Okay, so now what we want to see from these bears, remember, is we want to see if the bears, okay, so this is what I'm looking for. I want to see if the bears can find a bag holder, which is not a term. I did not make up the term bag holder. Somebody to take the other side of that trade, which the reason I use bag holder instead of buyer is because it's generic, because it's true for both sides. Hey, look at that. Look at the troublemakers here. Oh, okay. So this is, so you have to remember that with this trapped orders algorithm, it's trying its best to model things. So it can move around. And the reason that I'm okay with that in this indicator, you have to give it a bar or two, is because your objective is not to trade exactly with the bulls or the bears. Your objective is to see what they're doing and predict them. The thing that like yesterday's position, my favorite spot was here. Today, so far, this has been my favorite. I wouldn't have sold it because I don't know, maybe I would have. I don't know, it's hard to say. Is you want to say, oh, the bulls, if the bears get screwed over, then the bulls are going to want to play. And the time to participate is when you start getting everything you want. It's not, oh, there's the perfect signal. It's, oh my gosh, they're doing what I think they're doing. And then participating becomes so much easier. When you get what you expect because of the activities of institutions, you kind of know what's going on. And then participation, it just works. Like you just get what's going on. You know what's happening. You know how it works. So when it comes to like precision, exactly, on the right 1 minute bar or something, that if that matters to you, you're doing it wrong. What should matter to you is to be able to say, well, what's happening today? What's going on? And then build an expectation out of it. And then see if you get what you want. And then you participate as though you're right, because you're right. And the way that trading works is not to know the truth. This is going to sound really cheesy, but it's important. This is the not. It's not to know the truth. I don't know why I added an E. It's not to know it. It's to be. And this sounds really cheesy, but the point is that you are the best indication. Your understanding of the market is the best understanding of the market for any institutional player. The only way an institutional player can beat you is cheating. And if you know what they're doing, that doesn't even work. So it's important that you realize that you are what is accurate. You're like, well, I would do this or I would do that, or this makes sense or that makes sense. That's true, because the people at the top are dumber than you because they're entitled and they have no adversity, and all they do is chase around liquidity. They don't know what creates liquidity or where it comes from. They don't care. So your understanding tends to be better than those who can see liquidity, who can see it, because they don't have to think. They just shut off their brains and consume. So your job is to say, well, what would I do? What would I think? How do I feel about that? How would that affect me? Would I be frustrated or stressed or excited or entitled, or, the full range? And then you're the best indication. You're always the best indication. So it's to be the truth, not know it. So you're not trying to discover the truth. You're trying to see the players so that you can understand them. And then once you understand what's going on, you go, oh my gosh, I see what they're doing. I see why this is going to work. I see how that's going to crush this side or that side, because that would crush you. Then you all of a sudden know exactly what's going to happen, because that's what you would do. They pretty much always do what you would do if you had a bunch of money. Okay, so we're trying to figure out where they are. We do know a little bit about the market mechanics. So right here, I see these bears. Look, they're getting right up to that level where I think, that's a good spot. Makes sense. We're going to get support from the market maker inventory. The market maker inventory dump. This is, I need a better way to write that. It's like the market maker inventory. I don't know a good symbol for a dump. Down triangle. The M squared I down triangle. I don't know. I just don't want to be writing market maker every time. Nonetheless, an I, the inventory dump that's going to happen here at the expansion bar. So the bears could say, well, we'll use that to our advantage. It's still on the good side of our root position here. And, you know, if they keep it right, this position right here, if there's any lingering bulls on either one of these, they're really not pushing them positive, so we're not going to give them any extra rotating capital to deal with or use at all. So that'll keep them on the backside. It'll play around on the stop of that group. And if you remember, playing around at somebody's stop is a situation where it's typically when you sell, but you get into a position, let's say this is a short position, and the market goes against you. And what it does is it comes back and gives you a nice break even, and you don't close because you're an arrogant loser. And then it makes its way up, and then it's able to actually milk you for more profits. So the market will come back to your position and give you $0 in rotating profits. And that, I call that playing around in someone's stop, because nobody ever takes the break even. Even though I know through this section you were saying, I promise to close if it comes back. I know you said that. The market knows. It doesn't even have to listen to you. So that's what it looks like it's doing. It moved against them, comes back to their break even. They all committed to dump, and they won't dump. So right here we have our bearish sample. This looks like I'm getting just exactly what I want. Now remember, the game plan here was to get a switchback, and it looks like we got velocity up just enough that we could switch back down and sample, and that could give us the bulls. And the bears need a bag holder. So their job right now is to search out a bag holder. Can we find somebody else? Because we sort of destroyed our previous bag holders, these guys. We sort of destroyed those. Sorry. So can we find another one? And so we got to have that lean down. Now, what's going to happen here is if these bears can't find a bag holder, so our volatility expectation, I think, is going up a little bit here. The reason being because if these guys cannot find a bag holder, it's whoopsie daisy for the market, because the bears have failed to maintain control. This will turn into a multi-time frame divergence, and we'll be looking at this tomorrow, and it'll just look like a big fat trap. This whole low situation will just be a nasty bear trap, and we'll be talking about it for 2 or 3 days. If they can find a bag holder, if they can find a good bag holder, which means they are an institution, not just a shadow, meaning they impact tension. Shadow traders trade like institutions, but don't have the lateral breadth of an institution to impact tension. If it's a big player, tension will curl up like that. Price will move maybe like this, and then it'll go down below their position. So then I'll be like, oh, there it is. They have a bag holder. This position's upside down. I'll also be saying things like beware of teeth, but because of the context of the market, I'm not really going to be looking for teeth, because in this context, I'm expecting bears to look for a bag holder. So if we go down, watch out. We could see the market get down to and through this low, which is just the low of the range. I mean, it's not like the market is breaking or anything. It's just we got down below the range, and now the bears will have to, at that point, then the bears would have to deal with the zero test on the daily, which I absolutely think that the bulls are going to want to defend that. So our loadout here, or our risk profile, is these two scenarios. If these bears can't find a bag holder, then the bears are going to be paying for that. They didn't prep the market. They didn't get buyers to hold on and stuff. They're not doing that right. And if they do find a bag holder, then we could get down. So that's why I say our volatility expectation to me looks like it's going up. We have this expectation, if these things don't start working out in the next little while, our expectations start to say, well, we're going to break out one side or the other, which is just straight up volatility. One way or the other, we're going to move to an extreme. So that's what we're looking at right now. So all eyes should be right here. We're at -413 on our advanced decline. And I apologize. I know I talk a lot about the advanced decline. I was raised on advanced decline. That was mother's milk. So I look at this and I'm constantly trying to make estimates in my head about what I think it's going to be tomorrow's open, what it'll be here if we do these things. I'm constantly building out these like little charts in my head. It's like if we go far up, if we go sort of up, if we go flat, if we go sort of flat, we go far down. And I'm like, for 400 for me, like a really high move, we're going to be looking at maybe 300 on the advanced decline, 50 if it's a moderate move, negative 200, negative, I'm like filling out this in my head constantly. I was just raised on it. So to get ourselves a good sample here, we're going to need the bears to act if they don't act. And remember, for bears to do something here, if they ran an algorithm, they're going to be looking at 100 points about. So we'd be looking at 390. We'd be looking at like 490 or so if they run an algorithm to get ourselves that bullish sample. This is an interesting situation because the bears want the bulls to play. They want that because they need a bag holder. They need somebody to come in and participate. If they can't find it, it's through the roof. It's through the roof. That's what's going to happen. And I am kind of skeptical. I'm skeptical. Somebody insured the lows again. Oops. And what that means to me it's not like magic, right? It just means the lows are now much more difficult to break through. Who do you liquidate through the lows? Their stops got deleted because they have a positive spread. There's no stops down there. And the market's not dumb. It calculates the fact that these accounts have no risk on them, meaning when you move, if you take if we go up this way, there is a draw. Cash goes into the lows, these buy positions, because the outright contract makes money faster than the put loses. So there's a draw into the lows. If we move down, there's no draw. It doesn't come back. So if you're holding an outright contract here, the market can see that. It knows when it moves up, it pays money into the low, and when it moves down, it pulls money out of the low. But if you have a put insuring your position, then when it moves down, there's no money moving out of the lows, meaning the market's liable to pay the bears, these guys. So money will go into their account, but it's like, well, we don't have any bulls to pay that. So guess who pays it? The market. And guess who never pays the bill? The market. That's what makes the low so difficult to break through when you have an insurance policy. The market doesn't want to pay for you to make money, ever. The market finds somebody to pay you. And if it's break even for the market, so be it. They don't care as long as they don't pay. Or the market itself. I think it's part of the algorithm. The market's algorithm says, we don't pay out. Sorry, no, ever. There's no chance of the market losing. That'd be like the house losing in Vegas. Like, it doesn't make any sense at all. And you know what happens if you beat the house too much in Vegas? The house physically beats you. Same thing here. Anyway, so we've got our bears here. And I don't know about you, but I've seen better. I've seen better performance. In fact, we saw better performance here out of these bears. Looking at tension, you see that's moving flat. Now, I think the reason it's moving flat is because while the bears may have consumed some of that liquidity, I think they're hesitant. They should be very hesitant until after we see some bulls come in. My expectation would be, if this is like warfare, is to play it, a little cool. If we could get a sample, right? Maybe price goes like this. We get a sample. And then after that sample finishes, you wait for just a minute or two and then run your algorithms. So it's a little hesitant to like fully jump on until you know you got your got your bag holder. So this, while that I don't know if I'll call it failing, but it's, their activity level is lower. They're not really keeping price down so much here, and that might be because they're like, well, if the bears don't show up, this is going to blow up in our face, so let's not get totally invested here. And this makes perfect sense to me. They need an opponent. I think they burn these bridges, so they need an opponent, or they're not getting through the lows because of this problem right here. Those dang lows are insured. That's trouble. Trouble for the bears. Trouble, trouble, trouble. With a capital T. That was a Gary, Indiana. Was that a Music Man reference? Which none of my children get. And I reference the Music Man far more than you'd think. Anyway, so we're waiting for that to happen here. Now, let's say that the bears come in, the bulls come in, and they, we're going to get, if the bulls come in and the bears try to hit and it goes like this, whoo-wee. So what's interesting about this situation right here, if we got that, is if we get the bulls to come in, the bears to hit, and it to fail, it tells you a little something. It tells you that the bears lost the swing. And they're going to have to unwind all the origin position. They're going to need to unwind everything. Meaning, the reason that would be more significant to me is because you see the bears come in and actually try to slam those, try to create a bag holder. They give it their all and it fails. They lost the swing. And that means the market is likely going to keep going up to the upside. We're going to take advantage of that. It's going to roll up higher. That's how I would interpret this right now. If we go down and we see, I'm trying to paint these colors here. If we see the bulls come in and they hit and it goes like that, and we get up and then they slam it down, again, same thing. The bulls are losing control of the swing trade. And you see full out attacks by one side or the other, whether it be through running a news program, whether an algo program, anything, whether that they shut off half of the major platforms for traders so they can't access their trading, Robinhood shuts down again, whatever it is, something, if we see those attacks come in and then that side fails, I think this is kind of a pinch point. We're going to see happen because these bears, they could grab up a bag holder that gives them a little bit of ability to at least get through today's lows. Then later they're going to have to figure out how to get through the lows, those lows. It's going to take a lot of effort to do, but that's what's on the table right now. So our volatility expectation rising. Now this is going to front run the VIX. I see somebody said, so the VIX go up. Yes, Phil. I would expect the VIX to rise because these types of this situation here is going to proceed and in a change in volatility, which is very difficult to predict because the only way to predict it is to engage the market in a way that's difficult. Pay attention all day and being involved. So it's hard to predict those things because algorithms can't. No algorithm can do what I'm doing. You cannot write an algorithm to create the narrative the way I have created it. You can't, because it's not a human. And until you can program everything you are into a algorithm, which maybe that's been done, I don't know, you can't create an algorithm to create these narratives. So we can understand what's happening here, and we can see why it would be meaningful, the structure for it. And so that's going to precede volatility. We should see volatility increase on one of the outcomes. That's why I say I think this is going to lead to an increase in volatility. How much of an increase? No idea. I don't tend to look at the VIX for volatility. I tend to look at just this for volatility. But it should. I would expect it to lead to some sort of increase in volatility. So here we're not, at 390, the Bears are going to have to do something. It looks like the bulls can just sit back. I think the bulls have some positions here, not here. I think the bulls have done very little today. So the bears are going to have to do something here. Something. If they're going to get this VIX down, because it looks to me like the VIX is not moving back on its own. Let's even mark this out, because this is, mark this position, say about here. I remember the bears, I think the bears chose this spot because right behind it we have the market maker inventory to support the bearish position, so it gives them a little bit of support from the backside. Any moves up are going to lead to inventory dumps, and I think, personally, I'm sitting here thinking, oh, well, the plan here is then get the inventory dump like we had this morning or at the lows to help do some of the work, because it's all about work. Do some of that work to push the market down. I think that's why they picked it. But, I mean, look at that. So we only have 26 minutes or something left in the day. Guys are running out of juice, running out of steam to get things done. You can't wait forever. And, you know, we have seen a mentality in the bears, which I think is insane. I gotta be honest, I think it's insane. Where they like to run things, let's push it down into the close or something stupid. And you're like, well, it doesn't change the structure. It does hurt the retailers more. So if you're a buyer and you're not, let me define retailers for anyone who doesn't know my definition of a retailer. Now, when I think of a retailer, I don't think of what most people think of. I think of an account, a margined account that is unwilling or unable to hold overnight. This is what I think. I don't know why I write everything at an angle. This is what I think of as a retailer. So if you're saying to yourself, I don't have the margin, or I'm not willing to hold overnight because, you know, what if the market drops 50 points and blows me out? You're a retailer. That's what you are. You're a retailer. It doesn't matter how you file. If your broker is attaching margin to your trades, whether you asked him to or not, which doesn't really matter, they have the right to associate margin with your account. And they know that you're not really willing to hold for a day or two on a bet. You're a retailer. A big player. So let's see, a big player. They are cash only. And they will hold overnight. And they take complex positions. Now, when I say complex positions, I don't mean you have you take an option against it. I mean that your position as an institution is like you'll position in the future, the index, and like 70% of the stocks. You own the whole thing, top to bottom, and you have insurance. So you're significantly different. Most retailers wouldn't, well, I trade either futures or the SPX. Also, one of the things you can't do is, well, if you own a future contract, can you convert that into an SPX? Or do you have the ability to convert a bunch of your stocks into an SPY share? No, you don't. That's an institutional privilege they have. So they can roll between the things. They can own them and insure them however they want. They're very complicated, but they're all trading the same thing. So when you sweep a market down like this, what you're pressuring is the people who are simple, you know, that you just have a long or a short on the market here, and it shoves you out. And yeah, so I think that's why that the bears will do that as like a way to ditch their position, because it provides some forced liquidity they can cover on. I don't know. I think the market calls it rebalancing. Okay, so that's where we are. So I'm talking about this because it's starting to look like that's going to be on the minds of the bears. It looks to me like they're running out of time with 20 minutes or so left, And it's like, well, bears, what are you going to do if you can't find a bag holder? What's your plan then? And I think the safest thing to do if you don't have a bag holder is to ditch your position. And so an algo into the close would provide some forced liquidity rebalancing that would allow you to cover out the positions you have to get back to break even, rebalancing. And that would let you dump out your position. And then the bulls, they'll just sit with their positive spread. And if they do a dump like that, I think the market's going to start to want to drift a little bit higher and take a look at those bear stops. Anyone who didn't rebalance at the close is going to get pressured because they couldn't find a bag holder. So you're running out of clock here, bears. You're running out of it. There's no time. 20 minutes. And yeah, I guess I could get a little bit done in 20 minutes, but I mean, the last 30 minutes, we need to find somebody using velocity. That's where our big ticket here is. So 397. It's not terrible. Let's see if they ran an algo, get that to 490s. That could get us down with a sample here. If they don't do anything, I would imagine this to just keep bubbling closer to zero. So this would be an algo. We'd see that pop down. If there's no algo of 180 into the close, it would just sit and slowly make its way up against the bears. So we just have to wait, see if they're going to do it. If they don't, well, that's their fault. Markets like to make you pay for mistakes. Okay, so we've sort of worked out, I tried to talk about what I think about's going on right here so that you can have an idea about what I see in the terms of what's happening. Right here, looking at tension, we could think about tomorrow pretty easily. If the bears decide that they're going to just, run an algo and get jacked and run it up, then tomorrow there's a good chance we see 30-minute tension come up. Now, this will create an interesting thing that you need to keep in mind tomorrow. This will cause a zero test for the bears. A ZT, that's supposed to be a Z, I know I did. A zero test for the bears. They will have the ability to come in and attempt to defend 30-minute tension. Now, I don't think they'll be successful doing it, but they will have that chance. So there is often a price response as people attempt at least to defend 30-minute tension, because if the bears can pull 30-minute tension down and they're able to do that, then they're absolutely going to be getting a daily test tomorrow. So that's on the table for tomorrow. And you should also see that this, so we got this to the zero test, right? And that zero test really led to this low. That's the way I'm interpreting this low, is this zero test. Yes, it was drawn out, but that's the way zero tests are. They're not nice and clean like liquidity and stuff. They're a little bit more messy. You need to look into context. This is the damage that the bears were able to do. That's as much as they could accomplish. And remember, they didn't ever find a bag holder to pull this off, and they're running out of time to do it now. So this is about as good as they're getting, 14. And we're probably, even with a big old fat gap up, if it was a big fat gap up, we probably would still be on the bears side with 30-minute tension. So they've gotten kind of what they wanted, but they're not positioned in a very good spot right now with where they're at. So we have to think tomorrow, these bears are thinking, okay, if we got the 30-minute tension down, can we keep it down? Is there a way to sabotage these bulls, an effective strategy to keep them? And basically, it's like we have a 30-minute test to deal with. Tomorrow, potentially, they could get, bears have liquidity. I'd be skeptical of bearish liquidity until we get that 30-minute zero test, because that's going to be on their minds more than the liquidity. Then they'll want to defend it. And if they can defend it, then we have a daily test they have to worry about, which is a big deal. It's going to be a big deal getting that down to there. Most likely, if we have a gap up, is going to turn these positions, their pockets inside out. And a gap up will lead to tension here. It'll make its way up. Price would go, get there. We see some sort of price response. and 30-minute tension goes like that. And right there, we see the bears just get blown out as we get through, their stops wherever they may be. And then, we close somewhere like that's more likely to, I think, if they get turned upside down in the morning, that's the most likely thing. And that'll drive tension through zero. And then it's just and then today's lows were just a big fat trap to convince a bunch of bears that the probabilities had leaned down, but they weren't looking at the probabilities correctly. And so it just led to a bunch of people trying to sell. We're like, ooh, I see that it went down. I'll just sell, 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 sell. And then they get turned over and they catalyze the next upside move. That seems more likely to me at this point. But we'll see. I mean, we do need to see it play out first. And, these bears are out of time. They're screwing themselves. They should have run an algorithm 15 minutes ago, 20 minutes ago to get this stinking number down to we'll just eyeball about 500 or about 5. They should have done that, and they're not. They're not. Where's your algo, bears? You need it. You need to trap somebody in, or it's just going to hang you. You're just putting a noose around your neck. You can't drive markets down without a counterparty. The only time I've really seen that, and even then it wasn't, during the pandemic's rally down, even then they were finding counterparties. I know institutions were dumping, but we tracked it all the way down and they were still finding counterparties and driving it down. And the bulls were still able to buy in on their liquidity and drive things up against bears. The structure never fell apart. It was usually where that it fell apart or got really aggressive was overnight. So during the day, things worked out fine. And then basically the bears were trapping in everybody from the inside of the day. They weren't just ramming it down. They were looking for people on the other side to take up that liquidity. Then they would position, and then overnight it would liquidate those people. And that was what the pandemic ended up doing. But that only worked because it was legitimately causing behavioral changes in institutions. This is not that. So if you're like, well, so it's done it before. It's well, yes, and it can happen, but I don't know, 9 days out of 10, getting the bears to come in and just blast the market out the lows, which they can do, and they do every once in a while, it's just really expensive. And so I don't anticipate them to just blow money on the markets. They do it sometimes. They do. They do. I mean, you all have seen how bears act. It's like nothing, 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 everything. The bulls are more like, all right, let's get going a little bit here. Let's keep going. And they build it and they build it. And they're slow. They're easy to see. They're easy to trade with. They drive things up. They're predictable. Bears can just have, they're like all or nothing. And they're sort of difficult to pinpoint exactly when they're going to go all in. So could the bears drive this down tonight? Yeah. Any institution with a whole bunch of money could drive the market down tonight. The question isn't whether you can do it. It's whether you can do it and make a bunch of money doing it and also sustain that move. I mean, a market that just goes like this doesn't really, I mean, if you're putting billions of dollars into this, you failed. You failed. So yes, they can do it, but the bulls can also do it. I mean, that's the game that you're playing. It's two ultimate powers who have the ability to do anything they want, whenever they want. Joe, I think Joe just tried to steal my Zoom. Joe, don't steal my Zoom, Joe. They can do it. Joe, stop it. He keeps, I'm going to tell him no. I'm going to say, no, Joe, no. Okay, so if you're watching on the Zoom, Joe keeps trying to steal my Zoom. Oh, that's cool. Twitch. I didn't know they had a trading category. I thought I had to be like a buxom girl playing Minecraft to make it on Twitch. And I'm neither of those things, so I thought I would fail. But if they have a trading category, that's cool. I'll at least meet the trading category. I won't be a buxom girl. You doing so? Joe doesn't know. Joe, I stream. Charts every day, all day. Joe doesn't know I have a Zoom. He doesn't know about the Zoom. That's fine. It's fine. So, okay, so here's where we're at. Do you see the bears hitting? Let's take a look at, oh, look at that. So a little bit of puts going on, not much, nothing. I mean, this is ensuring the lows, I think. And I think that because, I mean, you look at the average size, it was just one big fat plop. That was pretty similar to what we saw this time. You see these big chunks of orders that help, I think, ensure the lows. And just, I think the bears are just waiting. They're just laying in wait. They're just laying in wait. Do they think the government's going to come in and subsidize their rally? Bunch of millennials. If I don't run my algorithm, the government will take care of me and run it for me. The Federal Reserve will come in and run my algorithm for me because I'm entitled. Is that what they're doing? I don't know, but they're not getting it. So they have a couple minutes left. In 2 minutes, we turn off our fun NBBO, which is the thing that says there's a national best bid and a best offer, and it puts the kibosh on a lot of cheaper algorithm types. So it'll be a lot easier to run algorithms, but this is looking, okay, so here we go. We're getting up to this right here. This is the Bears practical insurance policy, right? They were like, well, we'll do a position right next to that. So the market maker inventory will support our position. It's like, yeesh. Man, I'm almost thinking if I was a market maker, I'd say, well, actually, I don't think I'm going to dump. I think I'm going to hold my position because you guys are about to do this. That's trouble. That's trouble. Look, we're moving up. We're moving up in the world. We are getting to 336. 200. We could get up to like 0 by the close. Let's see if those market makers dump their position, because that's what's coming up right here. Right here. Actually, you know, on the the ES has got a little bit further. I'll mark it out on the ES here. And currently I'm using yellow to mark out the inventories, just so you could see. It's a little bit different. The ES seems to have, like on the SPY, you see how this came up and it tested that out? Well, on the ES, it didn't. So I think on the ES, there's a higher, see probably right here, there's a higher inventory spot than here. So we'll keep an eye on that. Oh, and it showed up here. I really gotta work out my drawing sets. They're like all right, we have 10 minutes. Okay, our NBBO. Shutting it off. We're gonna hit that market maker inventory level. They're gonna be able to dump their position across the market all crazy like without following any rules. That should be good. Nope. These bears are not getting a bag holder. This is really bad for the bears. Now, I think what's interesting about today, this low was a difficult trade. Difficult. And it was difficult because there was no clear bull in the lows. The only thing that gave you any heads up about it was a 30-minute zero test, which was difficult. You had to track volume here, and then here, and then here, and you had to recognize that there was an expansion bar, and it was testing yesterday's lows, and it was kind of complicated. Doable, but complicated. And complicated positions usually run better because they're not as crowded, but we'll see. Okay, look, there we go. We're getting some response out of our, this is the SPY. I think the SPY inventory is coming in here, and that's what's pushing this back. And the bears are like, yes, finally, inventory coming in to support our positions, sort of. Well, it's at least keeping it from not getting blown out right now. You still need bulls, and I don't think they're going to get it. Yeah. Okay, they got a little ways to go. They will have to run an algorithm at this point. They're going to need to manipulate the stocks to get this to come down and pick up a bullish position. Otherwise, it's just going to sit here. And then overnight, what are they going to do? Bears are doing it wrong. You're doing it wrong, Bears. And you know it. I think the way this is set up, they know it. They know what's going on. So let's assume that nothing happens overnight or into the close. We get a close about here or something, and it's just sideways. My expectation is that this will not get blown out because it's an insured position and they could not find a bag holder. So, you know, we could see some things like we saw last night, maybe some struggles or whatever, but initially or essentially at the end of the day, the market is going to try and blow out this position. I think the stops for these guys is likely here, up there. That's where their stops are. If I was to short this here, I'd probably stick a stop. Yeah, that's where I'd put it. Because that would, you know, these guys are wrong there, and, you know, you're a secondary, you're going to have to sort of share stops there. We probably could blow out a couple people right there, but I think institutional-wise, this is where your stop's going to be. You're wrong if we get up above here. That's where stops are going to be. So if we just close sideways and they don't run an algo into the close and get a bullish sample, which I don't know why you do that. They have had the last 2 trading closes, they had really bad experiences with that. It just folded them over immediately overnight. So yeah, if we go sideways, my expectation would be that this is the target and that we're not going to be blasting through the lows. Because they couldn't find a bag holder. They couldn't do it. You couldn't pull it off, Bears. And the goal of the bulls tomorrow will be to get tension back up over 0, and the Bears are going to have to eat that humble pie because they couldn't get the work done. You couldn't get your work done. You had some chores. You couldn't find the bag holder. Sorry. So tomorrow, if we go sideways, rule of thumb, hey, we could find some bulls in the morning, which could mean we open up and we move down and pick up some bulls. That's totally doable. Remember that. We could still find some bulls after these guys make a mistake, and if overnight we see the market launch through the roof, okay, good, that's what I want to see. But after that happens, we could find some bulls. The reason I think we would need some bulls is we got to have somebody buying to help push this through. So we'll have the buyer come in, we'll have the seller come in, they're going to topple the seller over, run the tension up through the roof, and we'll see a nice, disgusting blowout. These bears are out of time. They screwed it up. I think it's over. They're 5 minutes. I don't think they're going to shove a bunch of stocks down in 5 minutes. It's over. It's over, Bears. Let it go. You will let it go. The market's going to make sure you let it go. So that's my expectation. They couldn't pull it off. We couldn't find any bag holders. They couldn't get it to happen. They did, however, successfully get tension under 0, but because they couldn't find any bag holders, they can't pump tension. You know, pumping tension means find a loser. They couldn't do it. So tomorrow, my expectation is for the bulls to say, okay, you guys had your fun, and launch it up. If at the open, the bulls fail and the bears keep tension down, expect daily tension to come down to 0. This will be the next big target. That would be that. But because of today's actions, I don't think that's going to be the thing, but you do need to keep it in mind so if it happens, you're already ready for what that means. That's where we're at into this close. Nate, you're right. One stop and one entry. But this is not one stop and one entry. So we're not tracking one stop. We're tracking institutions that cover 3,000 stocks. Like they got to go across the whole market. They need to go. So that's the lateral side. They need a vertical, which is you do stocks, SPY, and the ES. So if you're going to impact prices here, you need to go vertical, and they use insurance. So these are enormous. These positions are hundreds of millions. They are not, these are massive orders. So we're trying to track big institutions that fit this profile where that they are enormous. So we were looking for a bull to come in to put tens to hundreds of millions of dollars into trying to push this one way, while we have a bear who's tens of hundreds of millions going in. We just want the big fish, the biggest fish out there. So we're not tracking little positions like 1,000 contracts. That's just baby fish. What we're doing, especially with this, is I don't actually think this is all of it. This models a large sum here. I don't think that there's just 1,000 contracts hedging. I think it's just sort of models it so we get a sense, because the amount of data you have to pull to track all of options properly is insane. It's enormous. To genuinely track it, you need the options from all stocks, which 3,000 stocks, each stock is going to have like 5,000 strikes on it. You have to do the call and the put, and then you'd have to probably take a look at the bid and the ask on those. That's per stock. Then you need to take a look at all the ETFs, because the SPY is just the most popular version of the heavyweights. There are like 50 of these dang things that track the SPY. You need all the ETF options, and you need all the futures. So the amount of options data it requires to actually look at the put position is so huge. It's just massive. It's very difficult to access those on platforms and stuff like, especially I'm never going to be able to pull that many. It's like just too many. So we're just modeling that, and we're looking for massive market-wide positions. We're not looking for little ones. That's why we use tension. Tension's a market-wide probability indicator, and only big institutions with millions can adjust probabilities out of their position. Little baby fish like 1,000, 10,000 contracts, no, you can't do it. 10,000 contracts is not enough, not even close. So we're trying to model that out. And what ends up happening is that institutions, turns out their risk limits sure look a lot like stops, and they play like stops. We see them blow out like stops. We see them unwind like stops. So the risk limit for an institutional player is, where am I wrong, not what's my stop loss limit. So they're saying, well, where would I be wrong? And that's what I look for to model out where their stops. And then when we get there, you need to see price sweep through and tension curl. If you don't see those, you did not blow out an institution. When an institution unwinds, it changes the probabilities of the exchange. It doesn't just sweep price. Like the whole probability thing goes because they liquidated. And they fight with each other all day. And what we're trying to do is find which side is winning and play with the winners. We don't play with losers, we play with winners. And right now, the Bears they were doing okay here, but then they could not make this gameplay happen. So the Bears are they're going to pay for that. We have the market maker inventory off of the expansion bar. An expansion bar is where the price sweeps through and doesn't retest, because most of price will retest. It's like, we didn't get a retest. So the market makers will have an inventory there they want to dump. So that's going to be here. Above that, these bears, and these bears consequently, because I think this was an attempt at an origin, a route for a swing trade, are going to have to pay for their mistake. And their stops initially are going to be here. And we still have the stops from yesterday that didn't get hit here, which those ones we might let go of even tracking, because overnight and all things that have happened, we could have potentially seen bears, hedge their position or cover somewhere in here or something like that. So I'm not going to be paying attention to these tomorrow. This one I will be, this one I won't be. So that's where we're at. These bears couldn't pull it off. They didn't get the work done that they needed to do. They have not picked up control. Tomorrow, maybe they could find some extra work, but my expectation is the bears to see their stop, to see their mistake, and say, you guys are going to pay. Yeah, so that's what I'm expecting tomorrow. Outside of that, that's all we got. Okay, I will come back and stream in the morning, because tomorrow morning is going to matter. I think there's going to be a lot of quick stuff going on in the morning that you're going to need to watch. Similar to this morning, you had to be moving real quick to be able to stay on top of that. Tomorrow, I think it's going to be similar to that. Oh, there we go. We got our We got our market maker inventory. Now that's out of the way. Well, you know. All right, I'll see you guys tomorrow.